I love SoundHound here. You know that, Bill. You know I love this stock. I really think that this stock is a home run. I mean, it has to test its highs here. Look at the big volume spikes, 1, 2, and then even though it's down volume 3, you want to look where there's a lot of volume. You can set up volume so that it comes from the side too, so you can see what ranges had the most volume. I like to do it like this. I don't like to complicate things. But you can see there's a great deal of volume right around 370 or something, where it basically bounced, which also happens to be the 200-day moving average. And then you can see a lot of volume right here at 603, and then up here around 715. So, early 6s to early 7s. It's at 539 right now. So you could buy it pretty much right now and be super confident it's at least going to go to the 6s and 7s. You can see the biggest spike, the biggest volume. It's really probably about the same amount of volume, but being that it was at about half of the price or less, it's a lot less money, traded here. It's less than half as much money traded down here at 237 than up here around $7. Same amount of volume, just more money traded over here because it's a higher price, right? So if you look at how much money was traded right here, around $6 or $7, it's basically telling you that that's where lots of traders agree the stock should be. And you can see it's pulled back on very light volume, and then another spike in volume 1 and 2 up here. And then basically, if you look at the entire, this kind of 2-week period, how much volume there was, this is this kind of little mountain of volume. It's all up here. So stock wants to go to 750 pretty easily. So that's why I feel like you could buy it here and not even really think about whether it's going to break out. You've got some safety. And by the time you figure out if it's not breaking out, or if the price volume activity looks weird or whatever happens, at least you're already at a profit. If it gets knocked down and starts to look like the proverbial crap's hitting the fan, do it from a profit, from a standpoint of maybe giving back some of your gains as opposed to buying it and seeing it drop. You can see the thing just popped, it gapped up. It gapped up, and notice this candle here is filled in with green. That is because the setting is candle trend, not just candlestick, but candle trend. And that just means that it closed lower than where it opened, right? It opened up here and it closed down here. However, it's still green because it's an up day. Remember, went from being down here to up here. But anyway, so, it's not as bullish as if you saw this thing open and then close near the high, right? This would be more bullish if the candle were hollow like this. But it's still an up day, right? Well, I'll take it. I really think I'm actually very happy that this is happening. I think the stock's giving you a chance to buy it. You can look at this key $5 range right here. I'm going to put a little line straight across, and it's breaking out above that on heavy volume. It just looks gorgeous to me. I know that you're once again bullish on it. Let's see if we can get some, if you want to really, if you want to use some leverage here, and that doesn't mean you're adding risk, because you can use leverage and put less money behind it, and you might be taking the same amount of risk. Instead of buying the stock, one thing to consider is a vertical spread. You could buy, let's just say, these are the July 5s, and I'm going to say buy. I'm going to turn it to a vertical spread. Hold on a sec, vertical spread, and it automatically fills 5.5. Both of these, 5.5 is not in the money yet. So you can pay 23 cents for this. I'm pretty sure you're gonna double your money on it. If the stock doesn't go anywhere, then this will go from 23 cents to 40 cents. Let's not think too far out, right? That's July, 66 days. So you're buying this at 23 cents. You're going to try to sell it at a profit. You think like that. That's it. Another thing you can do is you can buy the 5s, sell the 6. Right? You're going to sell the 6. You're going to pull in about 65 cents. But in this case, you're buying it at 40 cents, and you're trying to get out. I mean, the maximum it will go to is $1. The maximum that it'll go to is $1. Personally, I like the 5.5s. a little bit better. I mean, look, if this thing just moves above 5.5, you're gonna reach your maximum profit. It's just about there, right? It's right here. I mean, it seems like a super high probability trade. Now, also it's a very sensitive thing. If this is below 523 at expiration, you're gonna be at a loss. And just to be super clear for people who don't understand this very well, you could be at a loss in 5 minutes from now if the stock pulls back. The option, the vertical spread will lose value as the stock moves around. And sometimes we talk in terms of day of expiration because that's when you won't be able to use these options anymore. I'm going to go a little bit earlier on the calendar, and let's get to the June. The June traditionals, so they're not weeklies. It's the third Friday of the month. It's 38 days left. Let's go to, let's do the same thing just so we can draw a comparison. Let's just do this. Go to June and June automatically. All right, so that's 20 cents that we can pay for it. Try to ride it up to 50 cents. The thing is that when you have something that's so sensitive, right? If the stock moves in the wrong direction, you can lose the whole thing. If it moves, in this case, if it on expiration day is at 520 or less, or 520 is break even. If it's below 520, you're going to start to lose money. And if it goes below 5, you're going to lose all of it. So if you want to go a little bit wider, go a little bit further out, kind of create a strategy that is less volatile, less sensitive to the overall position, then you might feel a little bit more comfortable taking a bigger position that's more meaningful. If you're taking something you feel like it's a crapshoot, it's either going to go to zero or it'll double. It's really you're not really putting a meaningful amount of money because it could very easily evaporate. So you can go out a little bit further. Go out. Let's just say I like July. 66. We go a little bit further. Let's just say maybe the 4 or 5s, and then sell the 7s. So I'm going to go to the Julys. We're buying the 4.5s, and I don't know why it didn't pop over to the 7s, but now we're going to do that. If you take a look at the board, you can see the 4.5s are basically buying for 125. You see it's at 120 by 130. If you look at the 7s, they're at 40 cents by 50 cents. So basically, call that 45 cents that you're going to take in, and you're going to pay $1.35. The way that it comes across when you set up the trade is a lot simpler than that. So it just goes, all right, if you're going to pay 80 cents for this, that's the mid price. I see the natural price is 90 cents. That means that if you hit the bid, if someone were to sell as the market, it'd be 70 cents. So 70, 80, 90, 80 is the mid price. And you're looking at something that could go to $2.50. Could go to $2.50. You'll retain some value if it moves below 5. Remember, you're buying the 4.5 calls. So basically, you can just assume whatever the 4.5 calls, and then whatever the 4.5 calls is trading at, and you'd have to buy back the 7s, right? So if the 4.5 calls decline to, let's just say, $1, you might see that 7 go down to 20 cents or something like that. Then you're looking at a total of 80 cents, which is what you're buying it for right now. If I go to the chart, if you look at SoundHound, we just said that it's pretty much like it really wants to go to 7, maybe more, really between $6 and $7. Find where that volume is. Again, it's right up here. You can see this is exactly 7 right here where my crosshair is. Just wants to get there. Just wants to at least test that. So if you think about that bet that you're making, right? A lot of times people think about, is something going to explode higher, right? Is it just going to break out? And usually they just own the stock, or they own the cover, or they own the call, just the long call. That's it. They own the call. They want it to go as high as possible on an announcement. And you have to try to trade in a way that's comfortable for you. But, a lot of people are thinking, sky's the limit, right? And that actually creates kind of psychological hurdle for you to get over. If you want it to go as high as possible and sky's the limit, you're always thinking, man, if I sell this thing, what if it triples again tomorrow? That would be terrible. And so you wait. You want to see if you can, whatever. It goes down, it goes up, it doesn't matter. For some reason, you're convinced to wait it out. Anybody ever been in that position where you do a trade and you think, I'll wait? So you're waiting it out. At least in this case, as you're waiting, time's passing, and you've sold premium as part of this strategy. So just because time is passing, you're still making money. So, doing this vertical spread, as long as you understand the leverage aspect to it, you understand, what your risk is, you understand that you're using leverage. Your loss is limited to the amount of money that you have in the trade. So when you think about leverage, don't think about like buying on margin, then you have margin calls. When you're thinking about leverage, don't think about your house where you put up 10% and then it gets crushed and you actually owe the bank all this money. It's nothing like that. When I say leverage in this context, you are controlling a lot of you're controlling a big position, theoretically, and but your maximum loss is the amount that you're putting into it. So it has some psychological benefits if you could just understand leverages in the context that the thing could completely evaporate and go to zero. In this case, since you bought the 4.5 calls, for you to lose all of your value, it would have to be below 4.5. Any amount that it is above 4.5, one of those calls is going to have that much value, and you're short another call, basically. So keeping it nice and basic, nice and clean, the amount of money that you put into this is the maximum loss. So in this case, $83 for every spread that you buy. So, it's 100 shares basically times, it's 83 cents that you'd be paying. So that's $83. You buy 10 of these, you're looking at $830. It's not a heck of a lot of money that you're putting up there. But you're paying 83 cents, and the max gain in this case is going to be 2.5, or the max value, I should say, is going to be $2.5. Knowing that you're not looking for an explosive breakout, knowing that you're not looking for some big earnings announcement or an FDA approval or something that everyone's just waiting to see how it goes, knowing that you're not looking at the position through that lens, it's just so much more comfortable and highly probable. So this is just the physics of the market, right? This is just the stock wants to get up to that level just to test that high. And you can see by the price volume activity that it really does want to test that high. So getting up to $7, that's where your profit pretty much maxes out on the day of expiration. But if it breaks out, before expiration, like let's just say tomorrow it breaks out, your position might not max out. It depends on how much above the $7 mark it's going to be. But basically, as the option moves more and more in the money, it has less and less time value to it, less and less extrinsic value, and that's good for you. So if it breaks out, let's just say tomorrow or something, that extrinsic value that is in your short call, it goes away if it is deep enough in the money, and all this stuff it's gonna feel intimidating if you've never done it before. That's why you have people like us. Number one, you're not going to learn it if it's just theoretical and you're reading a book and even if you're paper trading and you have these the pretend accounts that they provide you with, really not going to matter enough to you to really think too hard about. Got to be in there. So if you want to do this, you can do this for $83. It's not a big risk. $830, maybe have some fun. And that could turn into $2,500 if it maxes out. You don't have to try to go for the max, right? If you turn $830 into $1,600, you have 100%. It's a nice little chunk of change. And all it has to do is get up to where it's proven that it really wants to go, which is right here.